So this video is brought to us by one of our fellow hustlers, guys. JS asked the question, why do altcoin prices go up or down according to what Bitcoin is doing? Can you explain the mechanics on how this works? Well, yes we can. And it's funny because I didn't know it, but when I started to do the digging on this question, it was something that I have seen happen, but just accepted as part of the business, right? But of course, when I get to do digging, guys, there are always gems. There are always diamonds. I always find them. Because to understand why we see this Bitcoin ripple effect, I like to call it, we have to kind of take a little bit of history lesson. We all know that Bitcoin, of course, got here in 2009. Prior to this, crypto was just an idea, something that was passed around, still being developed, right? Digitization of the dollar, novel concept. Won't get that much into it. But what happened when Bitcoin hit the market in 2009 is that it set a precedence, meaning every crypto to come in after that were to follow Bitcoin's example. And another thing, the early exchanges that supported Bitcoin only allowed for BTC to BTC trading, simply Bitcoin from one person to another. So we're talking 2010, 2011 here. However, as early as 2012, when other coins start to hit the market, like Litecoin, Purecoin, OpenCoin would be Ripple, that's next year, but Namecoin, the early first-gen cryptos, they call them. When they came into the market, the only place they had to go to was these early exchanges. These early exchanges only allow for trading in and out of BTC. So, naturally, when these new currencies hit the market, their only trading pair would have been Bitcoin. So you got the entire first generation between 2010 and 2013 that are all connected to Bitcoin in some form or fashion. This was the established norm in the early days of crypto. If you were looking to introduce a new project, 9 times out of 10, you needed to have some exposure to Bitcoin. Hey, from a marketing standpoint, if you didn't make it seem like Bitcoin, people wouldn't have even paid you any attention. So this was a factor that was just pressing down on the early stages of this market. With that, all of these early coins had to essentially tether themselves to Bitcoin in some form or fashion. With that, though, it also opened these coins up to being vulnerable to any major price movements that Bitcoin may go through. So when Bitcoin did decide to do its run up, it obviously brought the rest of the market with it. But the same thing happened when Bitcoin price crashed. It also brought down the rest of the market with it as well. Remember, this was 2012, 2013. This was before the iteration of stable coins to the market. This was before the iteration of crypto to fiat payment rails. The only entry and exit point for to the crypto space would have been Bitcoin. This was up until 2014. In 2014, Ethereum showed up. But why is that a problem? Well, even though Ethereum initially came into the market with the intention of being a better version of Bitcoin, they did the exact same thing by allowing so many people to build altcoins on top of Ethereum. It's a great thing that the future of the decentralized economy is built on Ethereum, but the same dynamic comes into play here. If Ethereum doesn't perform well, the altcoins, the projects that are built on Ethereum or ERC20s also won't perform well because their foundation is shaken. Oh, you guys have probably seen this. When Ethereum begins its fall, so do the rest of the altcoins. But when Ethereum goes up, it pulls the rest of the alts with it. That's what they call altcoin season. It's the moment, it's a period, a phase, if you will, in the market after Bitcoin's rally. Bitcoin will run up. It'll be a couple weeks. Then Ethereum will follow. And when Ethereum kicks off, that's when, you know, the space will tell you that it's alt season when Ethereum is doing its run up. But why, when one token begins its ascent, it creates an entire season of altcoin performance? It's because these altcoins are built on Ethereum. But what was Ethereum initially paired to when it came into the market? Bitcoin, right? So we have the same dynamics, the same thing playing out on both projects. You have first generation cryptos tethered to Bitcoin. Ethereum comes in to represent generation 2, but it's tethered to Bitcoin. But then Ethereum tethered itself to the rest of the altcoin space. So this is how you get that ripple effect. Bitcoin peaks out, let's just say 60,000. Ethereum follows suit, let's just say 5,000. Then we get that reversal. Bitcoin begins to come down. What follows right after that? Ethereum begins to come down. And when it's not until Ethereum begins to move that we start seeing 25% losses, 15%, 30%, 40% losses in some of our favorite altcoin projects. This is what I've been seeing play out in the markets for the last 3 years. Now, I know a lot of people will tell you, you can't predict these markets. Past performance is not indicative of future results. And I understand that. But here's what I always tell those people. We're not dealing with a traditional market. We're dealing with cryptocurrencies, which are based on code, which that code is essentially a series of ones and zeros making mathematical computations. Mathematics have always told me that 1 + 1 = 2, will always equal 2, and have always equaled 2. So although we can't predict market behavior, what we can see is patterns, because when you're talking about math, patterns are resemblance of probability, and probability is based on contributing factors. So in essence, if 1 + 1 = 2, always have and always will, then you can guarantee the next time you see 1 + 1, it's going to equal 2. In essence, we're not predicting anything. We're just identifying patterns and calculating the probability. 1 + 1 is always going to equal 2. Now, there is one exception to all of this, and this is something that I witnessed myself. They call them bear claws, or projects that tend to perform exceptionally well during a bear market, or ripping through the market, which would explain the whole bear claw thing. But one of those most popular bear claws would be XRP. And then when we break down a little bit as to why it performs this way, it all makes sense. Because, see, XRP came about in 2013, hit the market officially that winter, went, mainstream basically. By 2014, everybody knew what XRP was. But XRP was already pre-mined. All of its circulating supply existed from the moment it started, right? There's also no need to stake XRP, and there's no mining. So with those elements, XRP did not have to come into the market paired to Bitcoin, and it also didn't need to pair itself to Ethereum. So when we saw in 2017, when XRP ran up to nearly $2 in what was supposedly a bear phase or a bear market, XRP was ripping through the ranks. Same thing happened. I was here for this one as we approached the whole SEC situation, closing the end of 2020, guys. We were also considered to be in a bear phase. We did not know that we were only a month away from the rally, but at that time, everyone considered us to be in a bear market. But what did XRP do? We went from 45 to 55 to 65, 75, 83 cents. And then the SEC came in with the hammer. So that's a whole different story, guys. What I'm saying to you is this. Bitcoin ripple effect is simply caused by the amount of cryptos that were either built on, tied to, or backed by Bitcoin or Ethereum. In addition, we have just the recognition of these two projects. If you're completely new to the crypto space, the very first two tokens you're probably going to hear about are Bitcoin and Ethereum. So from a marketing standpoint, guys, how the public, how the consumer views that, if Bitcoin and Ethereum, and whichever one they pick to be third, or depending on which news station you're watching, but when Bitcoin and Ethereum don't do well, to the average consumer, that looks like that the entire industry is not doing well. So we have that playing on top of all of this too, guys. So we have some fundamental factors, some technical factors, and we just have human emotion all playing a part. Now, there is a silver lining to all of this. That is, we are now in a time of new generation of cryptos. Okay, I say it a lot on this channel, but with that, a lot of those assets are not connected to BTC or ETH, and in turn are not affected by their price behavior. Okay, technically we still have sentiment that we have to deal with that just kind of overshadows the entire thing, but we have those new projects, guys. And for example, our Power 42, 60% of the projects on that list are native standalone blockchains. That would mean that in the event that BTC or Ethereum were to crash or have a significant correction, once we break past the sentimental impact and whatever the fear and greed index is going to tell us, that utility era, guys, that's when they're going to shine. That's really when they're going to shine, because if Bitcoin's price isn't performing well, and neither is Ethereum, mainly because the gas fees have congested the network again, then you have projects like Solana or Terra or Tron or HBAR or Celo or Stellar Lumens or XDC or Algorand or XRP. Oh boy, must I check the list? But you get what I'm saying here, guys. We're entering a next phase, and I love the fact that that was the question we are leading this week off with, guys, because it brings so much clarity. It really does. So with all that being said, guys, you know what I'm going to tell you. Leave a like, comment, let me know your thoughts. Let me know what you think about this. Also, if you have any more questions that we need to answer on this channel, especially for those who are new to the space, drop those down as well. And while you're doing that, guys, you know the motto. I want you to have a great day. Have a prosperous day. Most importantly, if that money is digital, so is the hustle. I'll see y'all in the next one.
Vault is letting us build crypto wealth on autopilot. Right now, we can get 12.6 APY paid weekly and top-notch wallet security insured by BitGo, an industry leader. As a bonus for members of our network, you can enjoy extra quarterly interest by using code DHN2022. Details in the description.